Now moving along to our next panel, Betting on Green, What VCs Are Funding in Climate Tech. Please welcome session moderator Aria Safar, VP of Investments at LACI, and panelists Arteen Arabshahi, General Partner of Fika Ventures, Cedric Char, Principal at BMW iVentures, and Laura Katzman, Partner at Buoyant Ventures.
There we go.
Good morning.
Hi. Thank you all for joining us today. I'd love it if you could quickly introduce yourselves, your firm, and what sector you all invest in, and stage, sorry. Arteen.
Hello, my name is Arteen Arabshahi. I'm a general partner at Fika Ventures. We're about 10 years old, based here in LA. The firm started largely with a focus on B2B software, and we've kind of evolved that into a handful of other things, including energy investing. But I think of the group, I'm probably the most generalist of an investor with the least domain expertise in the category. So excited to be the dumbest one up here. And we invest at the pre-seed and seed stage.
Awesome. Hi, everyone. My name is Laura Katzman. I'm a partner at Buoyant Ventures. At Buoyant, we invest in the intelligence layer for the physical world. What that means is we're looking at software, AI, and simple hardware. So think sensors, cameras, something low cost off the shelf that's driving efficiencies, decarbonization, and resiliency. We do seed Series A investing. We like to lead rounds. We're a woman-owned firm headquartered in Chicago, but I'm based here in LA.
Hey everyone, my name is Cedric Char. I'm a principal with BMW iVentures, BMW's venture capital funds. We invest in seed through Series B stage startups that are touching or around the automotive value chain. So from upstream industrials and manufacturing all the way downstream to sales and aftermarket, repairs and maintenance, and everything in between, and then anything enterprise, software, SaaS, AI that the BMW mothership could use.
Arteen, I want to kick things off with you. So looking at the wider startup world, not just climate, how are founders who successfully raise VC dollars from Fika and other funds building startups differently compared to 2 to 3 years ago when AI entered the picture?
It's funny, I was wondering how long until we got into AI. We made it, I think, 7 seconds. I think, and I'm probably not the only one who can speak to this topic, but I definitely, so in my career, I was a VC for about 7 years, from like 2013 to 2020, and then I went to the operating side, and I came back about 3 years ago now as a VC. And the shift of like how you build a company now that AI is prevalent could not have been more palpable. Like I honestly think that just like, even in the last 2 years, it's changed so much, because I think, I won't do like the show of hands thing, but probably everyone in this room to some degree is using AI in their consumer lives and their personal lives. And obviously all of us are also people who work in the workplace in some way or another. And so the way people are building companies just inherently looks so different now than it did a number of years ago. And you see it in, I think you see it in a lot of like the early results and traction and things like this. Like I think for many years, I don't know, over the last 10 years, there's been this kind of like, what's going to be the next big technological platform shift, and then AI kind of came on the scene in a really big way and kind of answered that question. And so now I think a lot of what we're looking at is the results of how that has changed things. So tactically, like early stage companies, I think it's kind of bifurcated, where for software businesses, I think it's almost easier than ever to get your first few customers and kind of start. Can you hear me? Can you hear me from here? Nope. Should I just? I can go loud.
How loud?
Test yours.
Hello?
Hello?
No one likes AI. I get it. It's fine. Test. There we go. So I think on the software side, like you can get further with less, which has some positives to it, has some negatives to it, and then the other kind of bifurcated version of this is I also think it's opened up a lot of investors to categories that otherwise they were closed off from. And I think that has generated a lot of interest in entrepreneurs in categories that might be a little bit, before would have been a little too hard to pursue. And so you're seeing like deeper tech opportunities pop up. You're seeing, physical infrastructure stuff pop up in ways that I think 6, 7, 8 years ago, pre-AI, wasn't as much in the front or the forefront of the conversation in tech at large. So I'll stop because I could keep going, but hopefully that's enough.
No, thank you, Arteen. Laura, I want to zoom in a bit on the climate sector. Buoyant invests across energy, efficient computing, climate intelligence, and industrials. Where are you seeing VC dollars go within climate? And is energy, which fuels our data centers, taking all the oxygen in the room?
You're absolutely right that energy is sucking up a lot of oxygen in the room. I'd say for good reason, though, and what I mean by that is, we're seeing across climate sectors that there's a lot of pullback, both from geopolitical constraints, macroeconomic constraints, and just a general pullback in funding for sustainable technologies. And so energy kind of represents this bright spot right now in the landscape, and that's because it's largely accepted that energy is a bottleneck for future AI growth. So getting back to data centers, which is always part of the conversation these days too. We need to build more power generation and infrastructure in order to meet load growth driven by data center demand, and investors have noticed that. So they're investing across the energy landscape, whether that's from a grid-enhancing technology, battery storage, more generation, technologies that are making the most of the existing infrastructure that we have. And because of that, utilities are very popular among the VC community right now. They're always popular with climate tech VCs, but I'd say they're gaining popularity across the board with VCs. And that's because they have so much capital to put to work they need to put so much capital to work to modernize the grid to meet this moment, but they're doing it with a lot of pressure to not raise rates on their ratepayers. So a lot going on with energy. I'd say another category that we're excited about that maybe is a little bit has a lot of climate impact, but maybe not traditional, is efficient computing. And so what I mean by that is, how do you lower the energy intensity of AI? A quick example is a portfolio company of ours, Buoyant. They are an efficient database software company. So they have fundamentally rebuilt software architecture to run data analytics at scale in a way that lowers cost 10x and increases energy efficiency up to 90%. So we're starting to see a lot of capital follow those types of solutions too. On the flip side of that, that means maybe some more traditional climate categories that in the past 5 years have received more funding are facing more tight funding environments, and the capital is becoming a bit more selective. And so, I'm thinking about like carbon and climate management. I'm thinking about the built environment. I'm thinking about food and agriculture. And there's definitely good companies still getting funded in those categories, but it's more selective. So companies are really having to prove that they have good traction, they have a path to scale, and that they can hit profitability sooner than they would have needed to in the past 5 years.
Cedric, you're a part of BMW iVentures, so I imagine that the EV space has not gotten as much venture capital dollars in the last few years, but you all must still be investing. I'm curious sort of how you're looking at the transportation sector.
Yeah, absolutely. Well, I think you hit the nail on the head in that transportation and automotive specifically are notoriously tough. And I might get in trouble for saying this, but I think objectively, like, automotive is a terrible business to be in, right? You have high fixed costs and CapEx, thin margins, it's cyclical, and ultimately end consumer facing. And so to that point, we've been looking at a lot of industrial and manufacturing solutions, particularly those that can supercharge and improve utilization rates of existing manufacturing assets. I think now, especially given the proliferation of hardware startups and new OEMs, quote unquote, and the existing kind of available capacity of legacy OEMs, I think there's an interesting opportunity to marry the available production supply with this groundswell of new manufacturing demands. Within the vehicle itself, we continue to look at electrification technologies across the line items, and specifically those that have potential for a performance step change rather than incremental gains. So for example, solid-state batteries that drive better performance, lighter weight, smaller form factors, and faster charge times. And then lastly, I'll say technologies that have mixed or dual use. And I know this has been a buzzword of late, but to my earlier point of automotive being a terrible beachhead market, it's a great expansion market. Once you get past the multi-year design wins, then you are spec'd in for the next, call it decade plus. And so you don't have recurring revenues in the traditional sense of the word, but highly reoccurring revenues. And so businesses that are able to build early traction in other verticals to effectively subsidize the burn of securing automotive design wins, we think are very well positioned for durable growth.
Arteen, you've now made me self-conscious about AI and how all my questions have AI in them, but the next one is related. So like AI is taking a lot of dollars in the venture capital space broadly. So within climate, we see energy is taking it, but AI from all of venture capital is taking almost all the dollars. I'm curious, as a generalist fund, does AI sort of crowd out climate tech opportunities?
Well, first of all, I think you got stuck with the VCs, so you had to talk about AI. It's really our fault. It's not your fault. It's a good question. I think that so I'll speak about it from a couple different directions. One is just that like I think part of it depends on the size of the venture capital firm, and I mean that just like from a tactical perspective of like if you're pitching like a really large fund and they've got dozens of partners that are all investors, usually by then each of those investors has like a very defined sector expertise. And so I think for firms like that, it doesn't really get crowded out or changed in any way because you really have like domain experts and specialists, and maybe the ways that things change is how many people focused on specifically like AI infrastructure versus energy versus climate, et cetera. They have, but I think the view that's a little bit more kind of specific to, I'll say, Fika and firms of our size, which for context, we're about 11 people. We've got 6 on the investing team. So we're not massive, but we're not super small either. I think for firms like us, the way we kind of look at AI in general is it's kind of more of just like a platform shift that has impacted every company we look at. It's not like we have like the AI bucket and then like the climate energy bucket. It really is just kind of like we think of ourselves as like, what are the categories where new companies are forming now that have the most opportunity? And I think that AI just impacts all of those for early stage investors. And then the last flavor I would add is I do think we're still in this moment in the market where the very late stage capital intensive AI infrastructure, the OpenAIs, Anthropics of the world, just to name the obvious ones, they're still private companies. And so like it's a long conversation that probably doesn't need to happen right now, but like the fact that like people who are putting $100 billion into Anthropic and OpenAI right now are called the same thing as like what we are called, and I don't know your fund structures well enough to say what you're doing or not doing, but like we write checks of like $1 to $6 million. It doesn't really matter to us what's happening with like the $100 billion deployments at the very, very, very late stages, but we're all still called venture capital. And so the end of that point is just that I think once all these companies flush out into the public markets, we will actually be seeing an interesting redefining of capital allocation in venture capital, because right now you have all these like growth stage, multi-stage firms that manage, let's say, between $5 and $15 billion firms, and there's a short list of 10 of them that you can all look up, and you probably know all the names. I won't mention them all, but I think once all of these late stage opportunities go public, that capital has to start reinvesting again into like what I would say is like true private capital markets, so like Series B and C versus like Series F and et cetera. So I think that will readjust how people are investing, and I think that climate and energy is a sector that has gotten a bunch more renewed interest from generalist VCs because of the AI infrastructure push. But I think that like awakening is kind of here to stay just because of the way the market has shifted in the last few years.
Yeah. So Laura, we talk about AI a lot. It's very exciting. At the same time, we're seeing a lot of warning flags. So Meta recently started selling compute because they realized they had too much, which signals they're probably not using it all. OpenAI is potentially delaying its IPO as well. What happens to climate VC investing if demand for data centers and energy falls off a cliff?
Yeah, it's a good question. I don't think demand for data centers is going to fall off a cliff, but I do think we are going to see a market contraction. We are going to see an infrastructure overbuild. And that's been true of every infrastructure build out in the US. And so as investors, we have to figure out, if we're investing in this category, how do we invest despite where we're at in this cycle, and how are we looking for companies that have this, they're meeting a durable customer need. And so for the expected contraction, we think it will probably come sometime in the next 18 months, let's call it, as data centers are supposed to be coming online and they keep getting delayed. And they're getting delayed because there's a ton of community pushback. There are supply chain issues, there's power availability issues, there's workforce issues of just who's actually going to be building these. So an example of how we invest despite of this is an investment we made in a company called Hammerhead. They unlock stranded capacity from within a data center, so they don't go back to the grid for more power, they maximize the existing infrastructure today. And so no matter if we're in a period of energy abundance or contraction, all data centers want to increase their utilization. So we're really looking for like, what is that durable customer need? In terms of what happens to climate VC dollars once we see this contraction, I think a few things. I would love to see a more reallocation back to maybe more like other types of other climate sectors that have been looked over in the past year or so, particularly companies that, they're good companies, they're meeting customer demand, they have strong traction, they are having a lot of impact, but the funding has just been a little bit more scarce. I think climate dollars will also chase other high growth sectors. So you said dual use earlier, like dual use, space tech, frontier tech. There's a lot of categories that are considered high growth that still have climate impact. So I think we're going to see a reallocation to some of those sectors.
So Cedric, you invest in both hardware and software. Do you see corporate venture capital funds like BMW iVentures sort of being more willing to invest in capital-intensive categories than general VCs? Or kind of give us an intro to how a CVC thinks about software versus hardware.
Yeah, for sure. So I think it kind of circles back to Arteen's point of where CVC is relative to other fund sizes. So for context, we're a $300 million fund. So we are not structured per se to really lean into very capital intensive businesses. So we're looking for capital efficient, ideally capital efficient businesses both across hardware and software. That being said, we do have the ability to bring in the BMW group and back up the truck in highly strategic technologies, be it batteries, be it clean steel, clean fuels, what have you. So we do have that ability. I would say we are more open to looking at capital-intensive businesses than maybe Arteen and Laura, but compared to the mega funds who need to deploy billions of dollars, it's tough to hold a candle to that.
Okay, this is a question for the whole panel. So the start of this year, 2026, was marked by the SaaS apocalypse, very scary thing, where companies like ServiceNow and Salesforce saw their stocks drop 40%, have since rebounded to about 20% down from the previous highs. And that's because investors fear that the word AI, again, will either copy their tools and start doing everything within a tool like Claude, or allow enterprise to build their own tools. Do you think this is the beginning of software-forward VCs like yourselves moving into hardware more?
Go ahead. Yeah, we're all going to have a take on it. You should go first.
Well, I'll just say I love this question because I especially in the past month, I've been getting that question from so many people, particularly if I describe our thesis to someone that's new. People tell me, like, why are you investing in software? Like, why aren't you investing in hardware right now? And I do think it is a time for hardware founders, and I think that's really exciting to see. But I will say I don't think software is dead. I think the bar for investing in software has just gotten a lot higher because now these companies have to prove how you're defensible against AI coming in and copying your solution. And there's a handful of ways to do that. That can be through proprietary data, so companies that have a sensor or a camera or a drone or a super special, hard to replicate partnership for data. It could be founders that have deep domain expertise that's embedded into these products. So it's a vertical AI solution that a general LLM with a wrapper around it can't replicate. And a lot of it's customer trust too. A lot of these customers across energy and utilities, they're not comfortable putting their highly sensitive data into an LLM. So I think it is a time for hardware investors, but I think it's also just a time for software companies to really be able to prove why what they've built is defensible and durable.
Plus one, yes, and in the city of LA and improv. But yeah, I think the one other lens, so we're predominantly software investors. We've done a little bit of things that's like software-enabled hardware, or like admittedly stuff where like the hardware is not the innovation, because we are also like focusing on not super capitally intensive businesses. But that said, I think like the other like middle ground bucket is we've kind of started talking about businesses that are software first but have some element of like physicality. And so we've done a lot in construction and the trades as like investors on the software side. And then this year, one of our first investments is a company called Quantum Electric that does commercial electrical installs, like actually doing the electrical work. But they are leveraging AI to do things. They're partnering with local electricians, but then a lot of the estimating and the bidding of their processes is AI enabled, so that they can actually give estimates faster and more accurately. And so I think this is like one interesting example of the types of companies we're seeing today, where it's like, to Laura's point, like I think pure software, the bar for what is like a defensible, long-term, durable business just looks a little bit different in the age of Claude Code and things like this. But businesses that are software first but have elements of physicality, I think are also a really interesting kind of opportunity outside of just pure software or pure hardware.
Yeah, just to chime in, I mean, we're seeing just similar to how AI rapidly accelerated the deployment of software and code. I think we're seeing that same effect trickle down to hardware products, be it generative CAD or AI translating CAD to like 2D technical drawings within minutes. We're essentially seeing like founders being able to vibe code hardware products and take them to market very quickly, rapidly iterate on them, and then bring them and ramp them up to series production. Double clicking on Arteen's point, I think there's we've been seeing the shift on the software side from like seat-based SaaS pricing to more outcome-based and task-based pricing for these AI startups. I think kind of roll that forward to kind of the physical and production of like physical products, and customers are more willing to pay for essentially just the end products and the ultimate outcome. And so having, call it a full stack, i.e. software-enabled hardware, I think there's an increasing moat to be had and a massive value capture opportunity for those that are able to do so.
Another question for the panel. What is the single highest leverage thing a policymaker or corporate partner who is in the audience right now could do to de-risk a deal for a startup that you're working with?
Go ahead. Yeah.
Okay. This is going to be easier said than done, but if you have a successful pilot that everyone agrees the technology works and value's been delivered on everything there, the metrics that were supposed to be hit, decreasing the time to conversion to a fully paid contract would be really wonderful to see. Again, I know it's easier said than done with budget planning cycles and things like that.
I'm laughing only because it's so, I was gonna say almost the exact same
Were you?
thing. Well, because the flavor that I was gonna add to it was like a year or two ago when there was all of these like AI was again for the coming on the scene in a big way. There was all of this talk around experimental budgets for like, hey, let's go try something with AI and this and this, and obviously it's a little bit different in policy and the overlap with that. But I still think one of the things, so if you asked a year ago or 2 years ago, I would have been like, open up a budget, like try something out, like obviously do it safely and make sure the data is protected and all these things, but like try something out. And now I think even just in the last 18 months where we've gotten to is like a lot of places and folks and people are trying things out, and now the next phase of this is like, well, how much of this is just like you're trying something out to say that you're trying something out versus like you're actually using a thing and like you're going to keep using the thing? And so you said it much more eloquently, but like that was exactly the same instinct I had.
No, just to tag onto that too, I completely agree with that. And I think particularly at the stage that we invest in, the types of companies we invest in, if companies struggle to scale, it's not because the tech doesn't work, it's because product market fit hasn't been found yet. So like being able to show that there is budget for it and you are using it and it is valuable is just really helpful for companies when they're fundraising to be able to tell that story.
Yeah, literally ditto. Just having a playbook, a clear
Spend
playbook.
more money.
Yeah. Of pilot to enterprise-wide deployment and conversion would be super helpful. I think the noise to signal ratio of pilots is incredibly high, and from an investor standpoint, effectively very highly dilutive at this point, in my opinion. Corporates are doing dozens, if not hundreds, of POCs with the intentional strategy of having a low conversion rate. And so handing a founder just a clear and articulate roadmap of like what needs to happen post-pilot, and like when procurement comes in, like that's when the hard work starts. That's when you have internal conflicting incentives and stakeholders and multiple RFPs and bids and panels. And so it can be, after a successful pilot, still a 12 to 18 month period.
Okay, we're getting closer to the end. I have two lightning round questions and then a closer. How do you recommend, lightning round, just one idea. How do you recommend early stage climate founders approach fundraising today? Tips, tricks?
I don't know if it's any different today than it's always been, which is just like try to connect with an investor that has a shown interest in the space that you're building in, and also try to connect with them in a way that feels authentic. I think right now, maybe this is the difference. Like, just for context, like I wake up to probably 20 to 30 AI generated pitch emails a day, and I'm not special. But literally more than ever, I'm getting like these generic. It's not about an actual fit with like what I look for, and it becomes even hard. It desensitizes everything. So I know that's a lightning round. I'll shut up. But anyways, point is like be intentional about like which investors you actually want, because I think we're in a landscape where every investor is willing to just like explore everything because the whole world is changing so much, and so you're better off spending time with like 10 to 15 investors that you think could be a really good fit versus just like 150 investors who are investors that are willing to take a meeting.
I would also say fundraising is taking time, so give yourselves time, like at least I'd say 6 months to get around done. While the most hyped up companies are doing it much faster, that's not at all the norm, so just make sure you give yourselves appropriate time to build those connections with venture funds.
Yeah, and just quickly to add on, just kind of double down and focus on the fundamentals and the unit economics, and having a clear line of sight and a story to the next kind of de-risking inflection milestone.
Okay, lightning round part 2. What is one climate tech subsector you think is underpriced or overlooked right now?
I don't think it's underpriced or overlooked, but I think that like grid optimization and just like supply and demand right now is so out of whack, and I think anything that's making that more aligned is interesting.
So from an overlooked perspective, maybe climate resiliency, not to be confused with energy resiliency. I know LACI is doing a lot of incredible work with that. Last year with the LA fires, and even today there's several talks on resiliency, which is so great to see, but largely so much capital has gone towards decarbonization, and we need to see that start to shift over time.
I think resi solar and storage can be potentially underpriced, especially the bloodbath from rising interest rate environments and the expiration of the ITC. Now with the push for energy abundance and resilience, increasing unaffordability, and kind of the continued cost competitiveness of solar relative to other power generation sources.
Okay, and last question. So you're all investing in the future of climate tech. You have plenty of financial commitment to 2020 and beyond. But personally, what do you hope to see LA looks like after the Olympics wrap in 2028? What's your future vision for a greener city?
It's funny. The first thing I liked what Matt said earlier this morning about just like people leaving and being like, "Wow, the infrastructure here was really good. Like that was amazing." Like I actually, I don't know that I know that's not the most like pointed answer, but I do think that is kind of like, I don't know. LA gets a bad rap for so long for infrastructure, and even like air quality is still a thing, and like we don't get credit for the improvement of the last 10 or 20 years in that regard. And so I think LA, Olympics is going to be an amazing opportunity to like showcase. Not just what we can do, but what we've already done.
Yeah, I completely agree with that. I think the Olympics is a unique opportunity to leave a city better than it was before. And so if we could do that through public transportation, more clean energy, that is just a way to really support all the different Angelinos and not only increase, help climate benefits, but also just social benefits as well.
Yeah, I think to echo that, having LA as a sandbox for renewable energy and integration into the system, like we have abundant sunlight for solar, all of these depleted oil wells that we can potentially leverage for geothermal. We're right on the coast that we can leverage tidal or wave energy potentially. Being able to integrate all those various form factors and then roll them forward post Olympics, I think would be amazing.
Well, Cedric, Laura, Arteen, thank you all so much for joining us.
Thank you.